Welcome to the Deep Dive. Today we are cutting through the noise and going straight into the Q4 2025 earnings call for HOMB Bank shares, ticker HOMB.
And this was a fascinating one. I mean, on the one hand, you have a report with just incredibly strong internal fundamentals. We're talking record annual profits.
Right.
But on the other hand, you have an earnings call with the chairman, John Allison, who was, let's just say, not shy about tearing into the rest of the banking sector.
That's our mission today, to really unpack that for you. Why was the market so skeptical at first, even when the numbers were so good? We're going to distill the hard numbers from the really passionate commentary that explains why they operate the way they do.
I think what's crucial to understand is that the market tends to paint all regional banks with the same sort of broad brush. HOMB's results tell a completely different story. We need to look at the specific levers they pulled.
Okay, let's start with the headline numbers then. Despite all the turbulence out there, HOMB, well, they delivered. They reported GAAP diluted EPS right at 60 cents a share. Met consensus perfectly.
Exactly. But where they really stood out, where they blew past the street's forecasts, was revenue.
Yeah, let's get into that.
Reported revenue was $282.1 million. That's a beat of about $9 to $12 million over what analysts were expecting.
So that's a solid, 3 to 4% beat, which is significant in banking. That's not a small number.
It's not. And these numbers, they capped off a really exceptional year for them. Full year net profit was over $475 million.
Which was an 18.2% increase over the previous year. And the full year EPS hit $2.41. That's a 20% jump year over year. These are elite numbers in this space.
And yet you mentioned that divergence. Right after the release, the stock was down, something like 4% in pre-market trading.
It was. Record results and EPS beat, and the initial reaction is, something's wrong here. What's going on?
Well, that knee-jerk reaction says more about the sector than it does about HOMB, I think. You had that whole debate bubbling up again around credit card APR caps, and, that just hangs over the entire financial sector. Any bank stock gets hit by that general malaise.
So it's just sector-wide skepticism spilling over.
Exactly. The algorithms sell first and ask questions later. But it faded pretty quickly. Once the real analysts had time to digest the core drivers, the shares finished the day much, much stronger. It's a classic case of fundamentals winning out over temporary fear.
Okay, so let's dig into those core fundamentals, because this is where it gets really interesting. They are mastering profitability, especially when it comes to defending their net interest margin, or NIM.
The NIM resilience is absolutely the story here. It's the most critical driver. They reported their NIM actually improved from last quarter to 4.61%.
That's up 5 basis points. For anyone unfamiliar, a basis point is 0.01%. A 5 BP's expansion, when your peers are seeing their margins shrink, it's a huge operational win.
It's a huge win.
But how sustainable is that? I mean, where did that improvement actually come from? Was it a one-off?
No, it wasn't just luck. It was fueled directly by managing their funding costs. Specifically, their interest-bearing deposit costs fell by 15 basis points. 15, down to 2.47%. That just speaks to the stability of their deposit base. They actually grew total deposits by $150 million, and their non-interest-bearing deposits, the best kind of funding, held steady at around 22% of their total base.
And that's the separator, right? Successfully managing your cost of funds while others are just paying up to stop the bleeding.
And it feeds right into their other elite metric, efficiency. Banks are judged on their efficiency ratio, how well they control costs. Management has a laser focus on this. They reported an adjusted efficiency ratio of 39.53% for the quarter.
A sub 40% efficiency ratio that's practically unheard of for a bank this size in today's environment. It means for every dollar of revenue, they're only spending about 40 cents on operations. It's incredible discipline.
It really is their key strategic focus. Even for the full year, the ratio was an incredibly low 41.29%. We should be fair, though. The quarter did get a little boost from a couple of positive one-off items.
Let's quantify those then. Context is always important.
Sure. So they had a $4.9 million recovery on a lawsuit that finalized in the quarter. And they also called out $2.6 million in what they called event interest income.
Okay.
They estimate that added about 2 basis points to the NIM. So even if you strict that out, their underlying core margin was still a very strong 4.56%. The core performance is exceptional with or without those tailwinds.
So the profitability engine is firing on all cylinders.
All right.
But you've got to deploy that capital safely. How does the balance sheet look? Let's talk loan growth.
Total loans were up $400.2 million from last quarter, hitting $15.69 billion. And for the full year, growth was robust, $922 million, or about 6.24%.
And that growth wasn't just stuffed into one risky corner of the market either.
Precisely. The community bank origination was strong, nearly $1.2 billion in new volume. Half of that came from Florida, which is a huge growth driver for them.
Right.
And their specialized unit, CCFG, had a great rebound. It posted $236 million in net loan growth, which pushed that book back over $2 billion outstanding by year end.
And the call revealed some interesting timing things that made that quarterly number look so big.
Yes, exactly. Management noted that the $400 million in growth was actually higher than they expected because about $150 million in payoffs that were supposed to happen in Q4 slipped into 2026.
Ah, okay.
Yeah, the Q&A clarified it. One big loan closed early, another big payoff got pushed. As they said, it all evens out over a few quarters, but it definitely gave Q4 a temporary boost.
They also got into some of the underlying drivers, which I found fascinating. On multifamily lending, they're seeing growth from clients who are capitalizing on distressed loans from like the 2021 vintage.
It's smart business. They're using their strong capital position to step in where others are having to back away. And that ties right into that massive $350 million syndicated energy credit they talked about.
Right. That wasn't a new deal for them.
Not at all. It was a situation where they upsized the credit after the original lead bank got into trouble. They just stepped in, took over as lead, and bought out the other participants. They feel they're in a great, well-secured position on that one.
The growth is impressive, but growth at all costs is the very thing that Chairman rails against.
Mm-hmm.
So how are they doing on reserves, and are there any trouble spots?
Asset quality is still really strong. Non-performing loans are low, just 0.54% of total loans. And their allowance for credit losses, their reserve against future losses, is at 1.90%. The chairman explicitly said he wants to run that at 2.0%, so they'll keep building it.
But they were pretty transparent about a couple of problem credits they're working through. What's the detail there?
So the first is that DFW apartment loan. It's in the, call it $10 million ballpark. They had a deal to sell the note that fell through.
Right.
But, and this is key, they were able to apply a significant hard deposit from that buyer to the loan balance. It materially lowered their exposure, a great example of mitigating a bad situation.
And the second one was much bigger. The Texas C&I credit.
That's the Texas Commercial and Industrial Credit. That one's in the $90 to $100 million range. Now, they said they believe they're fully reserved for it, but it looks very likely it'll have to move to non-accrual status before they can finally get it resolved and off the books.
And moving a credit that size to non-accrual is a big step.
It's substantial. And the fact that they're talking about it so openly just shows how conservative and transparent they're being, which really fits their culture.
They also touched on their specialized marine lending book, Shore Premier Finance, which had a little bit of an uptick in delinquencies.
They did. A small increase in 90-day delinquencies there. They mostly chalked it up to painfully slow court processes. They gave this one frustrating example of a $10 million boat that's been arrested and just tied up in the courts for 9 months.
9 months.
Yeah. So it seems to be more about frustration with the legal system slowing down recovery than about ultimate losses.
Okay, now we have to get to the part of the call that really dominated the headlines. The chairman's view. John Allison's commentary was, it was something else.
He was in rare form. It wasn't just a corporate update. It felt like a declaration of principles, a critique of the entire banking sector. He spent a lot of time explaining why his bank is different.
He didn't pull any punches. He talked about self-inflicted damage from other banks' dilution, bad securities portfolios, paying way too much for acquisitions.
He blamed those bad decisions for why so many bank stocks trade at, 10 times earnings today versus 22.5 times back in 1998.
And he called it shareholder abuse. He railed against these dilutive M&A deals that need a 3 or 4 year earn back. In his words, those deals don't work.
And the stark differentiator he offered was HOMB's 2.05% full-year ROA return on assets. That is an elite number.
Yeah.
And he flat out said they have never intentionally done a dilutive deal.
And that ROA is what gives them the flexibility to be so disciplined, which they immediately reinforced when talking about their own M&A strategy.
Absolutely. The Mountain Commerce Bank Shares, or MCBI, deal is set to close in the first half of 2026, maybe April or May. And he touted it as being triple accretive from day one, a direct contrast to the deals he just slammed.
And because of that discipline, they have options. They have currency.
A lot of options. Management confirmed they're actively looking for more deals, even hinting at a second one in 2026. They're targeting places like Florida or Texas where they already have a footprint and can get maximum cost savings.
So that discipline has to contend with some pretty serious competitive headwinds, though, especially on loan pricing.
It is intense out there. And the chairman gave a classic example. He talked about the silly stuff competitors are offering.
I remember this part.
He used this stunning specific example of a floating rate loan being offered at prime minus 75 basis points.
With no floors.
No floor, a 6% ceiling, and the borrower can fix the rate at any time in the next decade.
Prime minus 75 with no floor is. That's a deal designed to lose money for the bank.
It's incredibly aggressive. He basically said he doesn't know how anyone competes with that, but noted his teams are still producing good yields by sticking to their discipline and focusing on relationships, not just chasing every low-margin deal.
So given that pressure, what's their outlook on the net interest margin for 2026? Can they hold the line?
They guided that they will strive to keep the NIM flat, which in this environment is actually pretty optimistic. They exited December at 4.59%, so that's a good starting point. They have about $1.2 billion in fixed-rate loans maturing at a lower rate, around 5.40%, which should help. And some CD portfolios could reprice lower, assuming competition lets them.
And on the expense side, the other half of that efficiency equation.
Continued discipline. That is the unwavering message. The standalone expense run rate for 2026 is projected to increase by only about 1% over the Q4 adjusted number. That kind of tight control is how they'll stay in that sub 40% efficiency zone.
And finally, capital return. That's a huge piece of their pro-shareholder theme, tying right back to the chairman's view on avoiding shareholder abuse.
Absolutely. They kept buying back stock, another $14.7 million in Q4, and the chairman made it explicit. His long-term goal is to buy back all 6+ million shares they're issuing for the Mountain Commerce acquisition. He says their high returns give them the unique ability to pull every capital handle at once, grow, buy back stock, and raise the dividend.
Okay, it is time for our final segment. Remember, we are distilling the raw insights from the call for you, the listener. And before we go on, we have to include the proper legal disclaimer.
This segment is for entertainment and discussion purposes only. We are just reporting on the data and the commentary from the earnings call. We are not making any recommendation to buy or sell any security. This is not financial advice.
With that necessary caveat out of the way,
Well,
put on your hedge fund analyst hat. Pitch us the outrageous but plausible trade idea based entirely on this call.
Okay, the thesis is simple. HOMB is a fundamentally superior bank. That 2.05% ROA, sub 40% efficiency, a massive 16.3% CET1 capital ratio. But it's trapped in what Chairman Allison called the losing generalist bank trade. That huge capital stack gives them options their peers just don't have.
So what's the trade?
The trade is a multi-pronged capital arbitrage. It focuses completely on management's ability to execute aggressive, non-dilutive capital deployment in 2026.
Okay, break that down for us. How does that translate into a specific move?
You go long HOMB and you're betting on a three-part play. First, you bet on the successful, highly accretive closure of that MCBI deal in the first half of the year. That's part one.
Simple enough.
Part two, you bet they aggressively execute the promised buyback of those 6+ million shares right after the deal closes. That immediately juices EPS growth. But the real kicker, the big variable, is part three.
Okay.
You bet on a second large-scale, non-dilutive acquisition being announced in the back half of 2026, likely targeting a discounted peer bank in Texas or Florida.
Why discounted peer specifically?
Because HOMB has the balance sheet strength to clean them up overnight. They can use their superior stock currency, acquire them, and immediately mark down the acquired bank's troubled securities portfolio, which is a huge problem for other banks right now. It would dramatically accelerate their growth faster than anyone on the street is currently expecting. It's a direct bet on Allison's discipline forcing opportunistic growth.
That is aggressive. And it's a huge bet on that management team staying true to its ethos.
The big takeaway from this call is that this is a company executing at an absolutely elite level. The chairman thinks they're one of the top dozen performing banks in the country, and yet the stock price is still tied to general sector sentiment, to macro headlines like that credit card APR debate.
So what does this all mean for you, the learner? Given the chairman's powerful stance on M&A, arguing that most deals just don't work, will HOMB's disciplined triple accretive strategy, backed by that incredible 2.05% ROA, be the catalyst that finally forces the market to distinguish between the real performance leaders and, well, the diluters? That's the question to mull over as we wrap up.
Thanks for joining us.
We'll see you next time for the next deep dive.